Okie dokie, this is the third part in our series on rental property investing. This is 101.2, that's why it's part 3, because it's point 2. The first part I'll link up here in case you haven't seen it, and after that I'll link the second part if you've watched the first part and somehow managed to make yourself to this video first. This video is going to focus on financing, that's right here, and what type of financing I recommend to my friends and family and use myself. Again, not financial advice on this channel. If you take my advice, you're going to lose all your money, you're going to lose all your loans, you're going to lose your houses, and you're going to go broke. So don't listen to anything I say. I am just a YouTuber. Okay, what kind of financing do you want? Well, on this channel, we only recommend and go with one kind of financing, and that is 30-year fixed-rate mortgages. Unless you already have 10 of those in your name, in which case you're going to want to go with private money, which we'll also discuss on the last slide of this video. You know, there's other financing out there. There's 15-year fixed rate right here and adjustable rate mortgages. The reason we don't go with these is because the payment's higher and your property doesn't cash flow. That's a 15-year right there. Adjustable rate might cash flow for a few years, but then guess what? As soon as interest rates go up, so does your payment, and your property doesn't cash flow anymore, or it cash flows less. There's other reasons to go a 30-year fixed rate mortgage. We discussed that in our how much they pay you to get a mortgage, or how much they pay you to get lending. I forget the name of the video, but I will link it right here for you. Go ahead and stop this video if you haven't seen it. Watch that one and see how much they pay you to take out 30 years of financing. Okay, next slide. On this slide, we'll just do a quick summary of why we do 30-year financing and how inflation affects it. That's what that other video that I recommended did, how much they pay you to finance a property. That's what they talk about in that video. That's what we talk about in that video. That's what I talk about in that video. So pretty much right here is what's going on. You get 30 years of fixed rate financing at 2.5% right now. Let's say you're doing owner occupied and your 30-year mortgage is 2.5% because you put down a decent down payment or whatever the case may be. Well, look at the government's inflation numbers here. This is from Shadow Stats. This red line is the current method used for inflation, and it shows right about 2% right here. Maybe 1%, 1.5%, I don't know. But just that inflation they're showing now offsets the interest rate in your mortgage because everything's inflating at more than half of what your mortgage rate is. So if it's 1.5% inflation and your mortgage is 2.5%, you're effectively paying 1%. We use this slide because this is the government's own numbers. This isn't some conspiracy theory. This isn't some crazy whack job that produces these statistics. But if you go back to 1980, that's the blue line here, this is how the government's own figures would calculate inflation should it be today. It's not like we're just making this stuff up. This is the government's numbers. So if you believe their numbers now, why didn't you believe them in 1980? I mean, it's pretty, they tell you it's the truth right now. But, if we use the 1980 numbers, we're somewhere right about 8% or possibly 9% inflation. And in that case, they'd be paying you 7% per year to get that mortgage or whatever the math works out to be. 6%, 7%, whatever. So yeah, that's just watch that video. It'll explain a lot better than I'm going to do here. So next slide. So the different kinds of mortgages you can get an FHA loan. So that would be the Federal Housing Administration backed loan. You qualify for one of those as a person. So you can have one at any time, is my understanding, and link in the comments down there if I'm wrong. They change the rules as much as they can on us, but anyway, FHA loan, it allows you to do a low down payment as little as 3.5%. The qualifier is you must be owner occupied. You must have that as a primary residence. If you don't use it as a primary residence, you cannot get an FHA loan. You have to certify in writing that you will be living in the property as a primary residence. It can't be your secondary or tertiary residence. So you can get one of these. That allows you to get into a rental property if you're going to be owner occupied for 3.5% down. You can put as much as you want, really, but it just gives you the option to put that little amount down. And on a $200,000 house, for instance, that would be $7,000. To where on a normal investment property loan, you have to put down 20%, which would be $40,000. So you can see if you can qualify for an FHA loan, you can get into a rental property as owner occupied. You know, you're supposed to live there for whatever the term is in your mortgage. Make sure you pay attention to that. Usually, like, I don't know, 1 year, 2 years, what the term is. There could possibly be some life circumstance that causes you to move out of that home before the 2 years. And, again, I can't advise you on this. You should talk to an attorney or your lender and tell them, hey, I'm moving out of my house. Is there any problem with my loan? It's an FHA loan. It's only been 6 months that I've lived there. I've never heard of a case where they come back and do anything about that. So, it's kind of up to you there. Just make sure you don't listen to me on that one. So anyway, that allows you to get into a rental property. You can live owner occupied in it and then move out later on when that 1 year, 2 year term's done and rent it out. And keep the same loan. You don't have to refinance it. You get to keep the same loan. So that's why you would use that one. A VA loan. If you qualify for a VA loan, you can do $0 down. It also helps you avoid PMI. That's private mortgage insurance, because if you get an FHA loan, they're going to tell you, oh, you qualify for a great 2.25% rate. That's so low. It's so much lower than you would get just using 30-year fixed rate financing on a normal loan. But then you got to pay that private mortgage insurance. So your APR on that 2.25% is actually like an entire percentage point more. So like 3.25%, which is just stupid. Just get a standard 30-year fixed rate mortgage and put as much down as you can and, whatever. But point is, you can get into it for 3.5% if that's all you have, and you get one of these. The VA loan, $0 down. You have to be owner occupied. Again, you don't have a choice. You have to move into the house. You have to certify that you're going to move into the house, and there will be a certain term written into the loan for how long you have to live there as owner occupied. And then once that term's up, be it, a year, 6 months, 2 years, whatever the loan terms say, you can keep that same VA loan and rent the property out. So that's one way to do that. That's why you would use a VA loan. Standard 30-year fixed rate debt. This is what most of us in our second and third and fourth loans are going to be. Because you can only really have one of these at a time. You can have as many of these as you want. Well, as many of these as they'll let you. Probably 5 to 10. You can get 10 per person. So, if you have a wife or spouse or husband or whatever, you can have 20, 10 in each person's name. That's nice. So you can own 20 rental properties, 30-year fixed rate financing, and take advantage of the inflation bonus that they give you. Again, watch that video on how much they pay you to borrow money. Okay. And then private money, when you run out of 30-year fixed rate loans, or you just don't want to use them, or you don't qualify for them, you can get private money. There are private lenders out there that will lend you money on short-term, long-term, mid-term basis at a certain percentage. It's usually more than your standard bank-issued or federally backed 30-year FHA, VA, or traditional mortgage. It might be 8% or 10% for this, but sometimes you have to do that. Probably Rental Property Investing 102 will talk about actually having to get business loans or financing through actual corporate loan through your bank. But you're not there yet because this is 101.2. If you were at that point, you wouldn't be watching this video. You'd be watching 102. All right, so to sum this one up, FHA loans, you can have one of those. Low down payment, and you have to be owner occupied. VA loans, $0 down. Yes, you can do that, but you have to be owner occupied. On a standard 30-year fixed rate mortgage, I think I forgot to mention you have to put 20% down if it's an investment property. You can put less down if you move into it as owner-occupied, but most of what you're going to do, because you can't really owner-occupy 10 houses at a time, you're going to go ahead and plan on putting 20% down on the property and any fix-up costs. But that'll let you qualify for up to 10 standard 30-year fixed-rate federally backed mortgages. The other thing I forgot to write on here, you can actually do portfolio loans. So there are lenders out there that keep the loan within their portfolio so they don't sell it off to Freddie or Fannie or Ginny or Janny. So, you know, let's say you go to like, I don't know, Wells Fargo. Wells Fargo will say, yeah, we'll go ahead and get you this 30-year fixed rate loan. The only problem is we don't sell it off to the government, so we have to hold that and we have to assume all the risk for it. So your interest rate's going to go ahead and be double what your normal 30-year interest rate is, and we're still going to need 20% down. But if you run out of these standard 30-year fixed and don't qualify for any of these, you can do a portfolio loan. I mean, heck, you could have as many of those as a bank will let you have. They don't care. It's not federally backed. You're just only allowed to have 10 federally backed mortgages or federally purchased mortgages. Yeah, the Federal Reserve is buying like a lot of mortgages right now, so it'd be federally owned mortgage. Okay, so anyway, that would be a portfolio loan. It's not on here. You can call banks and ask them if they do that, and if a bank does, it'll be a higher interest rate. That'll probably be, again, Rental Property Investing 102. If you're doing that, you're run out of these things, and you've run out of these things here and these things here. Okay, next slide. Heck yeah, there you go. That's your financing in hopefully less than 15 minutes. It looks like we're going to make that cutoff. I'll go ahead and link the other two before this right here. There'll be a subscribe somewhere on here, a little circle to subscribe to. Leave a comment if we missed anything on the loans. Just a quick overview of the things you qualify for. You can go ahead and Google all of that stuff again or watch other videos, but that's it. Okay, hey, y'all have a good day out there, and we'll talk to you later.